it's crazy to me because I want to say like a year or two ago, I guess when you were less real estate and a little bit more trading in stocks, you were talking to me about how, the raise in yields and interest rates impact the market.
Yes.
I think we've been going through that or experiencing that at a real high level over the last 2 to 3 weeks.
Right.
Love for you to, maybe talk through that a little bit, educate the audience and me.
Yeah. Well, one, I'm not a professional in this stuff, right? Just experienced in life, I guess. But there's different asset classes as money moves. So you have bonds, you have what we call securities, which is an umbrella of a bunch of different things, anything related to the market, essentially, right? So a stock, a mutual fund, an index fund, anything of that nature, right? And then you have your bank secured assets, so CD, savings, these types of things, right? So interest rates and yields create a unique relationship between the stock market and bonds, but essentially it comes down to banks' ability to lend/borrow money from the federal government. But I think the unique thing that's been added to that since 2008, and then what people don't talk a lot about is the financial feasibility restrictions on banks from the federal government. So anything that's governed by the federal government has to abide by certain financial guidelines,
right? Whether
you're a college, university, a bank, right? Talking about banks. So your balance sheet has to have a certain percent of this, a certain amount of cash. They use certain calculations and all this kind of stuff. Well, these calculations are getting stricter and stricter and stricter and stricter and stricter, and banks are becoming more risk averse because they don't want to get caught with their pants down like back in 2006 through 2008, right? So you have this unique thing right now where banks have more cash on their balance sheets than they've ever had before. They're very cash heavy, but they're also very risk averse. So you're seeing aggressive lending to commercial lines only regionally, not nationally, right? So what that does is it slows down corporate investment because they don't have ease of access to lending. It's still a lot easier to borrow money as a company today than it was 10, 15, 20 years ago. But then you get Janet Yellen that comes out and says, I'm not raising interest rates, but I am going to raise interest rates. Okay, well, why is she doing that? Politically, it could be driven by the current administration, right? Or it could be a really smart play for her to do that so that she can tell the market, don't worry about inflation, because if it does pop its head out, I'm going to raise interest rates, which suppresses inflation because it calms the economy down, essentially. So what was interesting, and we probably don't have enough time to talk about it here, so anybody can research this, was the market's response
right
to her doing that, essentially calling her bluff. And the market's response to that, the market was kind of in a downturn going into that announcement, and then when she made that announcement, the market spiked and then started dumping essentially federal yield securities, right? So money was coming out of bonds, and they were short selling bonds and things like that. So normally there's a check and balance system between the free market and the Fed in that area. But what the free market said is, we're not going to let you do it, right? We're not going to let you suppress the economy because we believe that the economy is poised for growth.
Right.
So if you are going to do that, let us show you what we've got so that you don't do that. And I think there's a reason she did not do that. So that's a lot of what is going on. But to make it simple, it used to be like in the early 2000s, 80s, even 90s, you can put some money in some municipal bonds, whether they're federal bonds or state bonds, or a city you were living in was selling some bonds, and you can make sometimes a steady 5 to 6% clip over the term of the bond. So if it was a 10-year bond or whatever it may be, if you were to put your money in bonds today, you're technically losing money.
Right.
So if you were to buy a bond today, you'd be like negative 0.5%, negative 1%. So literally a savings account at a bank that earns 0.25% at the high end is better than
right. So But then recently the treasury yield has moved to like 1.6, 1.7.
Yeah.
Tech stocks are selling off, cyclicals are rising, right? So for me, and I'm still a new investor, big in Tesla, big on Bitcoin. But I'm like, if you're getting a 5-10x from some of these tech stocks, why would you sell these for a 1.6 or 1.7 return, or go back to some of these Buffett dividend stocks? Like, that's the part that I don't understand, if that makes sense.
Yeah, I mean, it's complicated, but it has to do with people's portfolios, and then a lot of it on the institutional side is driven by derivatives, algorithms, and all this kind of crap, right, in computers. And so at the high, like institutional house model, they make money differently than you would, right? Okay. So if you're in a tech stock and you're making 5x, like if you got into some of these stocks in January of 2020, right, and then got out right before the sharp decline due to COVID in March, and then got back in, you're more than 5x. You could be like 20x in some instances, right? Well, that's cool for you because you put 10 grand into something and you killed it. That's like the kid that put 10,000 into GameStop, made 50 million or whatever, right?
Right.
Well, they've got a 20 billion, 30 billion, 5 billion, 2 billion fund that's diversified in a bunch of different things. And they have all these percentages that they deem as correct. And what's happened going into COVID is a lot of people's, like you, and hedge funds and banks and mutual funds portfolios were very heavy cash. So money on the sideline because everybody's anticipating a crash, right? And then very heavy stocks, right? Or securities. So that money has to go somewhere. So if treasury yields go up, it creates an opportunity for them to move money that way in theory. The other thing is people watch the treasury yield for as an indicator almost of things to come. So the way that the treasury yield moves, given its past history against market performance, you can say, okay, the treasury yield was at this 6 to 7 months or a year before the last crash, or the last economic slowdown, or something like that. So that's the other reason that they watch it. Beyond that, one last thing, right? Everybody's got their target price, and I think that's what people forget, right? That's why the market's getting interesting, because you're introducing a lot of money that's not institutional in nature or taught in school.
Right.
And traditional investors target a price and exit at that price, whether they dollar cost average their way to that price, or, and that price can be flexible. It can be within a dollar range or a 20-cent range. But so a lot of the exits are because some of these stocks are at 52-week highs or all-time highs, or we also look at things like, okay, if a stock rose 150% within an increment of this many days or this many weeks, then I'm going to trigger my exit. So it's interesting. I was having this conversation with somebody the other day, and they were saying, well, how do these people forecast this, right? Like, how do some of these people get on CNBC or a show or write an article that says, I forecast Tesla to get to this price, so get out and you'll be fine. Or I forecast a bubble in commercial real estate that's going to burst in 9 months or 3 months, right? And the funny answer to that is that they don't. They just almost say it every day, and then when it happens, they point back to it to tell you that they did. Nobody knows.
Right.
Nobody has an idea. Yeah.
Right. So it seems like, so you got the retail investor that, Tesla goes from $1 to 1,000.
Yeah.
And their thought is, okay, now we go from 1,000 to 10,000. Whereas the institutions may be, okay, because I hear Kramer say this all the time on I forget the name of his show right now, Mad Money. But he always say, take profits. So it's interesting because a lot of these new retail Wall Street bets and things like that, it's diamond hands, right? Which is really the 2020 version of Buffett's buy and hold strategy.
Yes.
But it's like the mainstream media is the one that's telling you, take profits.
Yeah.
So it seems to me that maybe there's a portion of what's happening is, okay, some of these, like you said, are at all-time highs. If we can get a little bit of money from these yields, it's less, volatile. So let's just take this 1.6, 1.7. Let's see how high it goes. But then my argument to that would be, as I've just got introduced to Michael Saylor, he's a huge Bitcoin bull. He's the one from MicroStrategies. If you're familiar with him, he's put like, $1 billion in there, and then he did a capital raise and borrowed $1 billion and put another $1 billion.
He's got a target for Bitcoin of like a forever target of 100,000 a coin. Yeah,
exactly. Right. So he keeps talking about his rationale for this Bitcoin move is the cost of capital, right? Every third word out of his mouth is the cost of capital. Yeah. He's saying that the real cost of capital is 15 to 20%, not, the non-inflation that everybody's saying. And he's saying that people that know money know this. So once again, when I balance that against a 1.7% yield, to me, this looks like a quick pivot, but then people are going to pivot back to the growth stocks and Bitcoin. I'm wondering if you see it that same way, or with a cost of capital of 15 to 20%, are people that know money really going to chase these little 1.7% yields? Or am I looking at it wrong?
No, I don't think you're looking at it wrong. I think it's a great question. The answer is it's circumstantial. So this is why normal people get lost in the macro nuances of the economy, whether it's the United States at a macro level or the whole world market at a macro level. And here's what I mean when I say it's circumstantial. So, and this is why I think some people that get on CNBC or people that write crazy tweets or anybody that has an extreme point of view is irrational, because what you're explaining doesn't make sense maybe for you or somebody listening to this channel, but it makes sense for the hedge fund that did that. Okay. It may make sense for him to call Bitcoin at $100,000, or it may not make sense for me to call that. Let me explain, right? Because you're also talking about profit taking. So profit taking is a sound strategy. Right? The whole reason you trade, the whole reason you invest in the market, the whole reason you do business is so that you can make profits.
Sure.
Your calculation for profit or your strategy for profit is circumstantial. And people get in trouble when they don't recognize their financial circumstance against their target, right? Better known as your risk to reward ratio. And it should stem from your circumstance, not from some book. So you can decide you want to be a technical trader, cool, all right? And you can follow study, analysis, big time traders, all that kind of stuff, follow their algorithms, all this kind of jazz, right?
Right.
You can trade the news, or you can trade fads, or you can trade social media, you can trade whatever you want. So here's what that looks like. If you're sitting, right, with a trading account balance of $10,000 and you are $1,000 liquid beyond that account. Okay. And you trade $5,000 in stocks on Monday, and 10 days later, whatever you're trading, now turns that 5,000 into 15,000. So you've got an unrealized gain of $10,000.
Sure.
Okay. All right. And you bring that argument to me. Well, I'm going to call you stupid. Right.
Okay.
Because your circumstance says, who cares what the price of whatever you're in is? Your circumstance calls for you to take that profit. Right. So if that's your circumstance and you come to me and you're trying to have this conversation with me, well, you're just plain dumb because you don't understand your circumstance and you got to take profit. Now, let's say you are a family fund and you have $100 million under management, right? And outside of the fund, the family is $75 million liquid. Okay.
Yeah.
Right. And 50 to $100 million in whatever, let's just say bonds or cash on the sideline, given the current market condition.
Sure.
And $50 million is in play in the market. And you got into Tesla back when it was $180, made it through the stock split, right, took some profit halfway through, and we're having this conversation. Well, it's different. It's circumstantially different. Do you see what I'm saying? So I think sometimes people, depending where they're at, from the $10,000 all the way up to the $100 million or beyond, try to listen to a guru or pay attention to a tweet or listen to CNBC or their buddy or their cousin or their uncle or their wife or their girlfriend or their husband, and there's no recognition of the circumstance. So you have to always understand that the basis of trading is profit, right? And there's short-term profit, long-term profit, right? Income throughout the way, all that kind of stuff. But if you're at the bottom end of that and you have 10,000, 5,000 in the market and you're a liquid 1,000 outside of that, you should not be paying attention to long-term profit. You're
Mm.
taking short-term profit because you have to establish a financial foundation. Now, the argument really should be you shouldn't even be in the market at that point.
Right.
But let's say you are, right? Which is cool, right? Power to anybody. I mean, I got into the market when I was like 14 years old, so I get it, right? I didn't have anything. But that's my answer to that all the time. And you don't have to be a genius or an economic, mastermind to understand that. So whenever you hear guidance or you're watching analysis or news or reading a book, take your circumstance into account first, recognize what it means for you to take profit, and then create short-term goals, income goals, and long-term goals. But really, big picture, if you've got less than 300 grand, in total liquid net worth, the word long-term when it comes to the market shouldn't play into your strategy. Like, you know what I mean? You should be worried about taking profit and cash accumulation, and then you can worry about security and long-term strategy and all this kind of stuff. We're not talking about somebody that has $500,000 in their 401k. That's totally different, right? But just to answer your question.
Gotcha. So what's your take on Bitcoin? Because I don't hear you talk about it a lot. I mean,
yeah. So fun story. My in-laws, who are awesome people, hit me up a couple of days ago, super excited that they bought virtual currency. And I don't own any, but super proud of them because that's exciting, right?
Right.
So my opinion on it is this: it is part of the future. To deny it is like denying the internet 20 years ago.
Okay.
You just got to figure out your part and play to do with it. So my circumstance, it's not something that I have time to watch or get to really know or invest in right this second. But I can tell you probably 75% to 90% of the people that I know are in it.
Okay.
So it's hard to ignore. And there's people that I know that bought a Bitcoin at $2,000. And there's people that I know that bought $25,000 at yesterday's prices. You know what I mean? So as long as there's demand, right? It is what it is, right? The argument is you don't know what it is, blah 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 blah, all this kind of stuff. You and I's favorite story is about the tulip flower
right
bubble,
yeah.
right? First bubble ever, right? Going gecko. So I think we live in a world where it doesn't matter where it came from or how it's institutionalized. It's all about supply and demand. It's like old school economic principles. As long as supply of Bitcoin is not infinite and demand is through the roof, whether it's real, not, like demand's demand, right? The minute I demand a Bitcoin and I give you $1 for it, Bitcoin just became real.
Right.
So if you're sitting somewhere in an office telling people that tomorrow morning all Bitcoin's going to disappear and your money's gone, you're irrational because you don't understand the market. Now, there could be a bubble, sure,
right,
but the bubble would have to be driven by the market,
right?
Because it's already created, right? It's the same reason Elon, your boy, and Tesla, right, can go on for so long not making money. It's just supply and demand, and then kind of this new mixture of how we buy today. We're driven by tribe, right?
Right.
Here we'll finish here for today. So it used to be, the market used to work like this. I made the first ever of this. That created demand, right? And then you met demand with supply, and even oversupplied. That's how products came to market. Now in modern economy, then it used to be, I can offer the biggest discount because that was cool, right? So there was 20 million sodas at one point, but there was only one soda to start with. So I brought the soda to market. Everybody wanted the soda. Demand rose. I met demand with supply. I controlled price, all that kind of stuff, right? And to me, a product like the soda when it first came out is like a Tesla car, is like the changeover in currency with Bitcoin and things like that, because nobody drank soda before soda. Was soda real? right? All that crazy stuff in the past that had like, drugs in it and all that it's all the same, right? So, but then you go to discounts, then you go to culture, right? There's 20, 30 years, especially in America, where supply was bred through culture, right? Don't you want to be this awesome man? Don't you want to be this great woman? Don't you want to be this hipster rock star person? Hip hop culture, like it was all driven by culture, right?
Right.
And there was an era was driven by patriotism, and that's how you drove products. Well, today it's tribe. So I want to be part of this group,
Right.
inclusivity, right? A following. That's why influencers are a huge thing today, fueled by social media. We can have this conversation at some point. I don't think social media created influencers. I think tribe mentality created them. Social media fueled them. But, so that's my answer to Bitcoin. The tribe mentality is driving demand. Demand created a real market backed by actual money. So yes, Bitcoin is real. And if cost of capital, right, continues to play a part in things, and the world becomes to continue to kind of operate in synergy, right, as a macro economy, and NFTs are introduced at a mass scale, and traditional currency value continues to decrease. I don't think it goes away in any of the lifetimes of anybody listening to this or their kids or grandkids. Yeah, man. Why am I not in it? Because I don't have time.
Hold on. Final question. It's really quick. Is it more likely
Yeah.
that Bitcoin goes the way of the tulip, or that it goes to 10 trillion like gold and Michael Saylor's correct? If you had to pick one, what's more likely?
That's a great question. I don't know, because we've lived in a world where assets were always tangible, and then assets started to become intangible, like as we were kids growing up, and then once we were young adults in adulthood. So if you think about it, like use music as a great example of that. Even though music is created in an intangible form, right? It's art. So it used to be in the past, but it wasn't traded in the past. Then if you wanted to buy music, you had to literally pay for a performance, right? Before there was cassettes and record players and all that kind of stuff, and vinyl. So it was tangible. I had to pay for you to hear your music. Then I had to buy a vinyl. Then I had to buy a tape. Then I had to buy a CD, right? And then it went intangible. Music didn't go away, right? So it's not like because the CD disappeared, I can't hear music anymore. Music still exists, but I'm not physically buying anything anymore. I used to pay per song.
Right.
Okay. Then I paid per album. Now I pay for streaming services, but it still exists. Supply and demand is there, but it's not a real thing. So I don't know. Maybe it could go that way, or it could not.
Okay. All right. We'll wrap it up. I can't think of a better place to end it. First episode, you guys have heard of the Wolf of Wall Street. Nawrass Aldabbagh is the Mamba of San Francisco. He'll be back with Ask Nawrass. Appreciate you doing this for me, buddy. Enjoy your Sunday, man.
All right, man. Have a good afternoon.